Good morning to everyone in our audience. I'm Brian Bailey. I'm the subject matter expert and senior policy analyst for the Federal Reserve Bank of Atlanta. My area of expertise is commercial real estate. I've spent a little over a decade at the Fed regarding commercial real estate as far as the implications for the economy as well as for lenders. Prior to my time at the Fed, I spent about 15 years on the private side of the industry. I ran real estate finance for Florida's largest commercial developer, Flagler. I was an executive at the Big Four accounting firm Ernst& Young, doing real estate work for their clients for many years. And then I spent some time with a private equity firm in Orlando. So looks like we are ready to go. So I will start off with talking a little bit about inflation. Inflation has struck back, and certainly there are impacts on the economy, the consumer, and commercial real estate. Next slide, please. Just for transparency purposes, these are my thoughts and not necessarily those of my colleagues at the Federal Reserve Bank of Atlanta nor the Federal Reserve System. Michael, are you able to advance the slide, please? There we go. Thank you. Awesome. Great. If we move to the next slide, on the agenda today, I'm going to talk about economic conditions, market trends that you probably are seeing and that may impact your business. And then I'm going to talk a little bit about finance and investment. And as we know, with the change in inflationary environment and the associated change in interest rates as the Fed moves to tame inflation, that will have implications for a change in economic conditions, market trends, as well as the finance and investment market. So let's go to the next slide. And this comes from the Federal Open Market Committee. These are the projections that the committee makes every quarter. And what you can see highlighted in blue are the projections that were made in September by the FOMC as far as their view of GDP. You can see in 2022 that GDP was revised to 0.2% for 2022, down from 1.7%. 2023 was revised downward from 1.7 to 1.2%, and 2024 was revised downward, the expectation from 1.9 to 1.7%. This reflects the impact of increasing interest rates and the slowing on the economy as the Federal Reserve is focused on bringing inflation under control. If you move to the right in the blue box, the FOMC is composed of a number of members. There are several forecast projections that go into making up these results. And for 2022, those results in September ranged from 0 to 0.5% projection for GDP growth. Those were revised downward from 1 to 2% in July. So the projections are reflecting this slowing that is taking place and is expected to take place. If we go back to the left and we look at kind of the yellow or orange shaded box, you can see the unemployment rate was revised upwards just a tad to reflect, again, some of this slowing, some of the greater headwinds that we believe will be created by increasing interest rates, which will have a bearing on inflation and already are having a bearing on inflation. So certainly the expectation is that there will be some slowing going on in the economy, over the foreseeable future. On the next slide, you can see this is contributions to U.S. gross domestic product. And you can see that stable growth up until the pandemic. Then we had a significant contraction in 2020, followed by a pretty significant rebound in 2021. And then we have had, because of the support payments, we've had, very strong growth up until 2022, when the first quarter results were negative, roughly 1.6%. So a modest contraction of 1.6%, driven significantly by some of the issues with our foreign trade partners. We all know about the tragedy unfolding in Ukraine, and certainly that slowing abroad had significant implications for the export piece of the US economy. And then in the second quarter, we're down, a very small contraction of 0.6%, driven primarily due to issues with inventory, and investment, as businesses are anticipating some of the slowing, some of the slowing into next year, which has impacted their investments. On the slide we're on currently, this represents job growth, and as you can see, almost all the results are very, very strong. The U.S. economy is creating 2, 3, 400,000 jobs a month. On average, it's probably 300,000 over the last several months. I'm firmly in the camp that we need to create 100 to 125,000 jobs a month, just due to population growth. So the part of the population ages into the primary work cohorts. We need to create roughly 100 to 125,000 jobs a month to keep up with that population growth. And so from that standpoint, the economy is creating jobs in excess of what we need to keep up with population growth, which is a very good omen, in the fact that we're putting more and more people, we continue to put them back to work, which is an excellent dynamic for economic activity and for the need for commercial real estate. On the next slide, talking about unemployment and labor force participation rates. So we see here in green that U3, which is the most widely quoted unemployment rate in the press, roughly 3.5%. So we are at or very close to the 50-year lows that we experienced prior to the pandemic. I like to look at a broader definition of unemployment, which is U6, which is in dark blue here. And what you see, and the reason I like U6 is because U6 counts folks who have multiple part-time jobs but want a full-time job. They also count people who've given up looking for work as unemployed. And so from that standpoint, we see a little bit more true picture. And right now, unemployment rates for U6, roughly 6.7%. Again, very close or at the 50-year lows that we experienced prior to the pandemic. I've given you a little bit of context here. You can see the very severe, dire consequences of COVID on the economy, as most of us were forced to shelter in place early on in the pandemic. And you see that in 2020 as U6 spiked to 23, 24%. Contrast that with what we saw during the aftermath of 2008, where U6, roughly spiked to roughly 17%. So, a much, much different circumstance regarding COVID versus the financial crisis. So certainly, we have been given time to get folks back to work, which is good news. Now, one of the questions we've been asked a lot is what's going on with the participation rate. We saw it fall off dramatically during the pandemic. It's come back a little bit, but certainly not near the levels that it was pre-pandemic. And that is driven because we've had roughly 3 to 4 million retirements during the year plus after the pandemic. We also have a couple of million folks who are citing uh, the effects of long-term COVID as condition that they're unable to work. So there are some segments that we've seen an uptick in folks retiring or an uptick in folks who are unable to work because of COVID. At the same point, certainly, my fingers are crossed for the folks who've got COVID, that they will be able to, the medical field will be able to figure out some assistance for them that will make it them eligible to return to the workforce. Additionally, we know that retirees on fixed incomes do not typically fare terribly well during heightened times of inflation. From that standpoint, some of the retirees associated with COVID may return to the workforce. So it's a kind of a to be determined factor, but certainly the labor participation rate is not at levels that we would, that we were at pre-pandemic. On the next slide, if we look at jobless claims, yes, thank you. So you can see here that, roughly we're at 200,000 jobs a week, 250,000 jobs a week, kind of in that range over the last several months. But the last 20 years, shows a very, contrasting picture when you see, 2008 and the layoffs. At that point, at the height of that period, we reached 652,000 jobs, unemployment claims in 1 week. At the same point, contrast that with COVID, when in 1 week, over 6 million people filed for unemployment. So, again, very, very different circumstances. At the same point, low interest rates and the associated support from the government have allowed those folks to return to work, and in a number of instances, we've surpassed the levels, the pre-pandemic levels in certain segments, and we'll talk about that in a few minutes. On the next slide, one of the questions that's been asked is, what is going on with people's finances? Have they saved a significant amount of money, and is that allowing them to make discretionary spending lifestyle choices right now? So what we see here is that the savings rate kind of rode along between 5 and 10% up until the pandemic, and that first spike is directly correlated with the onset of the pandemic and the support programs that were pushed out to the public. And from that standpoint, savings rates skyrocketed to rates that have never been seen before in this entire data set, which I'm only showing 20 years. It actually goes back 60 years. But you can see here that savings rates skyrocketed to almost 34%. Then we had the second wave of COVID, and again, people's savings rates. We had another round of support, and that support spiked savings rate once again. But then we've seen savings rates tail off as the economy reopened, and currently it's at roughly 3.5%, which is very, very close to an all-time low. And so, from that standpoint, it is my belief that inflation has taken a bigger bite of the average consumer's paycheck. And from that standpoint, it has impacted their savings rate. And we have burned through a significant amount of the savings that was saved up associated with the support payments. On the next slide, we can look at consumer confidence. You see a lot of volatility, but certainly over the last couple of years, you see a downward trend. And from that standpoint, certainly we know that inflation is having a bigger implication, and it's taking a it's weighing more on consumer sentiment from that standpoint. So that is certainly something that we're watching very, very closely right now as we are trying to gauge kind of the impact of inflation, because we know that roughly 68% of the economy is driven by the consumer. And in that case, if their sentiment begins to wane pretty significantly, we know that they will pare back spending, which will then have other consequences throughout the economy. If we can move to the next slide, please. So, one of the things that we wanted to talk about today was inflation, and this breaks out CPI by a number of segments. And so you can see on the left we see CPI running at 8.2%. When we exclude food and energy, that's core, and it's 6.6%. As you progress to the right, you can see food and beverages up almost 11%. And you can see on our heat map that that rate of growth, that year over year change by month, is accelerating. And what we know is that prices at the grocery stores, prices for food are growing. And from that standpoint, they are taking a bigger bite out of the consumer's paycheck. If we move immediately to the right, again, another area that is taking a bigger bite out of all of our paychecks, and that is energy. Certainly, prices at the pump have waned a little bit, but certainly you can see here that over the last couple of years, that the year-over-year change is positive and very, very significant. When you're talking 20 and 30%. And as you would expect, if you go down that column, to 2020, when we were sheltered in place, when we weren't driving our cars to work, from that standpoint, energy prices, the growth was negative, and that is represented in blue. Continuing to the right, we see housing prices, and what we know is that there's been an acceleration in rents, acceleration in interest payments, which has pushed up um, and certainly made housing less affordable from folks. So from that standpoint, that is an area that we continue to watch. Let's kind of transition a little bit to the right. So one of the areas we're watching is lodging. So we saw, again, a significant decline in lodging as we sheltered in place during 2020. And then as we began to get comfortable with the issues with the health conditions associated with the onset of COVID, that caused folks to begin to travel. And so our heat map went from blue, where prices were declining, to red, where prices were growing very, very fast, driven primarily by leisure and by limited service hotels. As we all went to the beach, business travel was not yet back. And then in the last few months, we've begun to see that price increase taper off very dramatically. And so our heat map went from a dark shade of red to a very kind of to a white, kind of a light shade of pink. And from that standpoint, I do believe that there are consumers who were impacted earlier on by inflation, and from that standpoint, they had to make difficult decisions to pare back some of the discretionary areas of their personal budget. And one of the easiest is to cut back on travel. So from that standpoint, there were less people that went to the beach this summer. If we continue to move to the right, let's go all the way to the right, and let's look at vehicle pricing. So we know that some of the issues were driven by the closure and reopening of the economy, We also know that some of the issues with inflation have been driven by the supply chain. And so you can look at vehicles pricing, both new and used, in the furthest columns from the right on the right. And when was the last time that you actually made money owning a used car? And so from that standpoint, you can see on the very right that used vehicle pricing, grew sometimes upwards of 40% because of issues where folks could not get enough vehicles. That is beginning to wane a little bit. And from that standpoint, I think that that signals to me and others that there is and has been some improvement in the supply chain. So some good news, some early omens that we may beginning to see inflation recede a little bit. Certainly, there are a lot of factors that go into inflation, both from the supply and demand standpoint. Certainly, monetary policy can change some of that, but certainly there are a number of factors, both from the monetary as well as fiscal as well as geopolitical, that impact inflation. So, if we could go to the next slide, this is Chair Powell, our leader of the Federal Reserve. And coming out of Jackson Hole, he talked about while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are unfortunately the costs of reducing inflation, but a failure to restore price stability would mean far greater pain. So, in my opinion here, Chair Powell is setting the stage and articulating, what the Fed's monetary policy stance is, and that we are very, very focused on taming inflation. And we know that there will be, some slowing, some headwinds for an economy where, unemployment rates are at 50-year lows. So, another quote from his Jackson Hole speech: "Reducing inflation is likely to require a sustained period of below trend growth. Moreover, these will very likely be some softening in the labor market conditions." So again, what we talked about earlier reflected in the projections that there will be some softening in the labor markets in the foreseeable future. On the next slide, we can see one of the trends that's going on in the US today, and that is the population migration. So, technology, in my opinion, technology has enhanced this as we are able to work remotely. But what we've seen is kind of two distinct trends in my mind. One is the one associated with COVID, where folks went from high density markets, they moved out of those markets, migrated out of them into markets where there wasn't quite as high a density, and that was driven by the pandemic. Now, in some instances, that may work in reverse as we are more and more comfortable, with the health implications associated, with the pandemic as we've learned more about that. At the same point, there's a wave that's been going on for a significant period of time. And that, in essence, was folks who were migrating from higher cost markets to lower cost markets. From that standpoint, a lot of them waited until they retired, in essence, to move from the Northeast or from Chicago to places like Florida or to Texas. But technology has, enhanced mobility. It's enhanced not only personal mobility, but it's enhanced business mobility. And from that standpoint, businesses now are able to, have workers work from home or from nodes. And from that standpoint, technology has accelerated this wave of folks that are moving out of some of these higher cost markets. That has implications for a number of issues associated with commercial real estate. One is just sheer size as we have more folks moving into smaller, areas that have not seen as much commercial real estate growth. That will necessitate the need for more commercial real estate. At the same point, areas that they move out of may very well mean that there are less population in those areas, which may leave folks who are left with a higher tax burden per se, a higher infrastructure burden. So from that standpoint, we know that there are changes occurring as we speak in this area. On the next slide, one of the things that we're watching very closely, and there is a very significant issue associated with it today, is housing. Home affordability is at all-time lows, and it's been enhanced because of the increase in interest rates over the last year. So watching it very closely, because certainly if there are less homes built, there are potential for layoffs in the construction industry. There are issues with potentially when slowing the maturation process of folks moving from apartments to how single family homes to ownership, and from that standpoint, this dynamic can slow that down pretty markedly. On the next slide, what we see here is housing starts in green or single family, which have tailed off pretty significantly, and a lot of that's driven by the rise in interest rates, as the 30-year fixed mortgage is at 7%, roughly 7% today. Multifamily, continues to remain pretty robust. At the same point, from that standpoint, I do think that there are some issues that are beginning to, begin to kind of become a little bit more apparent, in that lots of the multifamily that we're building is aimed toward the high-end luxury space. And from that standpoint, I'm just curious, how deep is that pool of renters? Are they able to continue to build at the rate and have that pool of renters satisfy that increased construction? So on the next slide, my areas of concern in the short term, areas associated with the consumer. If the consumer is impacted, and we know that some segments of the consumer, inflation is impacting them harder, much more direly. So in areas of sub-median income as well as median income levels are impacted. The other thing we know is that as consumers pare back their spending, that will have implications for hospitality. It will have implications for retail. It could, I emphasize, could have implications for industrial, as you think about how much of consumer spending in the last 15 years has shifted from in-person traditional bricks and mortar retailers to the e-commerce crowd, the likes of Amazon. From that standpoint, we are generating a significant amount of sales driven by consumer spending out of the back of a warehouse. I think there may be others as well. Self-storage certainly stands out, potentially because of the challenges associated with the consumer and others. Multifamily right now, occupancy rates are very strong. However, I just have a question regarding more and more households are citing affordability as an issue. And with sizable amounts of apartment units underway, does this group of renters that is, targeted by the luxury multifamily development crowd, is that group big enough to satisfy the amount of units that are under construction? It's going to be a wait and see dynamic, but I think right now the answer is there's going to be more headwinds in that space. The office of the future. What's it going to look like? What is the hybrid in office remote structure? Where will it optimally end? Certainly, I think we will be back in the office, but I don't think it's going to be the extremes like we had pre-pandemic, where a lot of us were in the office 5 days a week. I don't think it's going to be the other extreme where everybody will be working from home all 5 days either. I think we'll land on a hybrid. But the question is, if there's softness, which there invariably will be, what happens is that businesses trade up space. So if you're in B space and you can get A space for the same amount that you're paying for B, you're probably going to trade up to A. And the same thing in C. If you're paying whatever in C and it's the same as B when it softens, then you're probably going to trade up to B space. What does that mean for the impact on, to a lesser degree, B, but certainly C class space going forward? Will we have significant volumes of that space that will be vacant? And then let's talk about financing. So non-bank lending, so the private equity, hedge funds, family offices, that space is less transparent than bank financing, and it has grown very, very rapidly. Non-banks as a class of borrowers offer higher loan to value ratios, which could create risk for other lenders, assuming that they're a big enough factor, have a big enough influence in the lending market. We know that the bid ask spread has widened across the commercial real estate spectrum, causing many more deals to falter. Not only office, but we've heard of self storage, we've heard of net lease deals. It is across the spectrum right now as that bid ask spread has widened pretty significantly. Market participants are telling me they believe cap rates are up 50 to 200 basis points, depending on location, property type, etc. In some instances, we've heard reports that value is off 8 to 12%. In others, that value decline has been more in the neighborhood of 20%. So certainly there is a very significant slowing going on in commercial real estate. And then I would just want to say that if the data continues to indicate the need to increase Fed funds rates, as the Fed has been doing, that could create greater upward pressure on the likes of 10-year Treasury and alternative rates of return, alternative investments. From that standpoint, we could see, some changes in that area. Let's kind of move to the next slide really quick. I won't spend too much time on hospitality, but we've seen a pretty decent bounce back in hospitality because it was very impacted, significantly impacted by the likes of COVID. So certainly it's good to see people traveling again. At the same point, we are picking up some indications that there is a pullback in hospitality rates, which is probably associated with issues with the consumer. On the next slide, we know multifamily occupancy very, very strong across the nation. In essence, functionally full. But on the next slide, when we look at the change in the last year, we can see that 60% of the markets actually had a decrease in their occupancy rates. Occupancy went down in all of the markets in orange. So beginning to see a little bit of that softening. Again, we're still at levels where we're functionally full. But from that standpoint, we are beginning to see a little bit more of this, accelerated building going on. And from that standpoint, it is beginning to impact the occupancy rates in a majority of the U.S. markets that we've seen in the last year. On the next slide, what we know by class is that occupancy rates are very, very high, 96, 97%. I would argue, that's less than 2 weeks to turn a unit, and that's a pretty short order. That's a pretty short time frame to turn a unit. So again, occupancy rates are very, very healthy, but again, softening a little bit. On the next slide, we see some projections. This projection is put together by Axiometrics, RealPage, and from that standpoint, you can see new supply in blue, and you can see demand in orange. And from that standpoint, during the pandemic, we had lots more demand. Now all of a sudden, that's shifting, and we're seeing supply beginning to exceed demand, which should bring some relief to the heightened effective rent growth that we've seen over the last 12 months. Finally, some interesting facts about multifamily. On the next slide, you can see that the percent of population living in multi-generational households has quadrupled since 1971. Of those aged 25 to 29, 37% of men live with mom and dad, and only 26% of women live with mom and dad, live with their parents. Those are pretty significant percentages of folks living at home. Certainly, they may represent an untapped market for multifamily, which may very well be good for the heightened rate of units that are being built. On the other hand, it could be a signal of things to come as more and more folks may move back in with mom and dad, and that may create a higher percentage of multi-generational households, which would not be a good omen for multifamily. Utility prices up double digits in the last 12 months. Certainly, that is a significant concern because that's taking away that growth is taking away from discretionary spending. And then what we know is housing affordability nationally is at a record low. On the next slide, this represents retail sales trends. The demise that was highly acclaimed in the press of the traditional bricks and mortar retailers, was heralded, overrepresented. We can see here that traditional bricks and mortar sales growth stabilizing around 8%. So, certainly that is a good omen for traditional retailers. Online e-commerce, you can see that from the red bar there, the healthy sales growth continues to occur, and that right now the shaded area represented by e-commerce represents about 15% of total retail sales. So about 15% of all retail sales come out of the back of a distribution center. That number has grown. Certainly seeing some areas of retail that are more challenged right now. If you would expect, food prices have grown very significantly, and from that standpoint, restaurants are having a harder time making it. We have seen, in my view, kind of the tip of that in that a number of mom and pop restaurants have closed. There are retailers that in retail generally have, kind of lower margins. And from that standpoint, there are a number of retail store operators that are reporting more duressed, stressed conditions. From that standpoint, we need to continue to watch that, in my opinion, as we may say, as retail has done well because we've not built a lot of it in the last 15 years due to e-commerce. Due to that trend, we've not built a lot of strip centers. At the same point, we're beginning to hear, more and more issues of weakening in that area. On the next slide, I'll talk a little bit about office, and you can see here that, one of the common denominators is that the nation's biggest markets are those with the highest vacancy. My belief is that those larger tenants concentrated in those cities have a higher percent of folks that travel. They have the financial wherewithal to make the investment in systems to realize some of that utilization, some of that increased efficiency. And from that standpoint, I do believe that the concentrations of efficiency will be focused in these larger cities. As you think about it, it's easier for a business with 10 stories to wring out one or two to consolidate to 8 or 9 versus the average tenant who is 3 or 4,000 square feet. And for them, it's a lot of energy to cut their space by 10%, 300 square feet, or 20%, 600 square feet. So from that standpoint, I do think that a lot of the efficiency is going to be derived by the larger tenants that are concentrated in some of the nation's biggest office markets. On the next slide, one of the dynamics that we do know is that certain segments in the job market have replaced all of the jobs compared to January 1st, 2020. So pre-pandemic levels. So in this instance, total, we have more jobs than we did pre-pandemic, and concentrated in transportation and utilities, information, financial activities, and professional business services. Those last three, which are in the shaded area, have the highest correlation to office using space, office using employers. So from that standpoint, we have put back more jobs than we had in these areas that have the highest correlation with office space. So from that standpoint, when we're trying to gauge what does the future look like as far as the office of the future, it's not an issue as far as the number of office workers that we have. We have more office workers than we had pre-pandemic. The areas that are struggling the most, again, leisure and hospitality, other and government, and probably the correlation there is, especially in leisure and hospitality, those workers, their skill sets, they don't have robust skill sets, and lower skilled workers are historically the workers that struggle the most and take the most time to get back to employment coming out of a downturn. On the next slide, kind of switching to lending. I'm sorry, let's go one more, please. Yeah, so on originations, what we see here is that in 2021, banks and Freddie and Fannie, the GSEs, represented the biggest market share, had the most market share. But life insurance, CMBS, debt funds, and unsecured REITs had a very sizable piece, and those are the areas that have grown the most over the last several years. And we know that some of those lenders, particularly the private investors, the debt funds, the unsecured REITs, are more apt to offer higher LTV loans. So they're willing to advance more proceeds. From that standpoint, those loans may have less margin of error. So on the next slide, we can see that loan to value by group over the last several years, CMBS, international banks, life insurance companies, national banks, all kind of less than roughly 64% loan to value. It's the regional local banks, as well as these investor driven funds that tend to offer higher LTVs, particularly in the case of investor driven, and in the case of hedge funds, private equity, they offer over 70% LTV, which again is not the end of the world, but it does potentially reduce the margin of error in an environment where we're seeing, value, commercial real estate property prices decline. On the next slide, real quick, this is my boss, Raphael Bostic, the president and CEO of the Atlanta Fed. And in September, last month, he articulated his stance on monetary policy. Again, very data driven, data dependent. But at the time, he said, ideally, I would like to reach a point where policy is moderately restrictive, between 4 and 4.5% by the end of this year, and then hold at that level and see how the economy and prices react. So, in essence, moving from an accommodative policy position to neutral, and then moving to one that's moderately restrictive. A quote, we're 7 months into the tightening cycle. The past couple of monthly inflation points produced a mixed bag, with some evidence that the pace of month-to-month price increases has slowed. But the August inflation reports were a sobering reminder that price pressures remain broad and stubborn, unquote. So again, Raphael wants to move to, in this case, a position that is moderately restrictive, somewhere between 4 and 4.5%. And what we know is that this potentially has implications for other forms of investment, and debt costs, et cetera. So on the next slide, real quick. So these are 10-year Treasury rates. We know in the last few days that the 10-year Treasury has moved over 4%. So from that standpoint, we've seen a very, very marked increase in the 10-year Treasury since the beginning of 2022. And that has implications for both debt service costs as well as alternative rates of investment. And what we know is that has an implication and a part and influence over commercial real estate cap rates, which are shown on the next slide. So we see on the next slide, there you go, cap rates. And cap rates, in essence, have trended downward over the last 20 some odd years worth of data that we're showing here. We've seen a compression in those cap rates, but really we've been in a period where there's been very, very modest inflation up until the last year. And from that standpoint, as the Fed increases Fed fund rates, as the markets respond in the way that they see fit, influencing the 10-year Treasury, et cetera, that may very well change the course for the likes of cap rates. On the next slide, we see this represents the spread between the 10-year Treasury and cap rates. So in essence, you've had, areas where there's been significant premium for the risk that owners take in the commercial real estate space. There have also been other times where, in my mind, owners may not have been adequately compensated for the risks that they took, i.e., 2006 and 2007, when we saw the spreads compress to 100 to 200 basis points above the 10-year Treasury. We've seen that compression accelerate in 2021 and 2022. And from that standpoint, we need to watch it, because my view is, as these spreads compress, the probability that cap rates increases grows significantly. On the next slide, and I'm almost done here, so if you've got a few questions, feel free to put them in the chat. On the left, this is a chart put together from data from Green Street Advisors. I like Green Street's information because it's composed of both transactions as well as appraisals. From that standpoint, it shows that values are down just a hair over the last 12 months. On the right, it's what we know is that loans that have higher LTV have less margin of error. And if you are a lender, or if you are an owner that is looking at financing options, what we know is 65% LTV provides more margin of error than 75%, and 75% provides more margin of error compared to 85%. So, from that standpoint, I like to tease my banking friends, being a bank regulator, that the higher LTV loans that you originate um, is the opportunity to spend more time with their regulators. And I know that that makes everybody, in the regulated lending space thrilled to hear about the opportunity to spend more time with their regulators. And some of them even liken it to being called to the principal's office. But in essence, what we do know is values are declining. And if you've got loans that have 85% LTV at origination, that LTV is going up pretty quickly as value is coming down. And in instances, we know that the probability that the likelihood that lenders may get the keys grows once they become, significantly, once those LTVs, cross, 100. On the next slide, so inflation is having an impact on consumer spending. It's having an impact on interest rates. It's having an impact on property operating expense growth. It's having an impact on business costs, having an impact on labor costs. So inflation is having impacts which could very well impact commercial real estate from a number of tangents. It could cause the consumer to have less discretionary spending available. From that standpoint, it may impact, business revenue, which may then impact, the availability, employment, sales. It could very well impact the likes of operating expense growth. As we know, real estate taxes, insurance, utilities, and labor probably are all up double digits in the last year. Those costs are up double digits. So it is having an impact on commercial real estate. In closing, on the last slide, economic conditions remain healthy. We have a very strong jobs market. Very good news there. The lack of labor is causing some businesses to report the inability to fully reopen. From that standpoint, when do those businesses right size because of that inability to reopen? Heightening inflation levels are impacting consumer behavior and property operations cost. Higher operating costs at properties probably will lead to the erosion of NOI, which could impact value. Upward pressure on 10-year treasuries probably is going to increase debt costs as well as cap rates. So in essence, property valuations could be impacted from both the numerator and the denominator. And loans with greater LTVs have less margin of error and potentially represent greater risk to owners and lenders. With that, I've got a few minutes left. I see a couple of questions. What are the risks associated due to a strong dollar? So it's a good question. So roughly 12% of the U.S. economy is driven by trade. And from that standpoint, a stronger dollar makes goods made in America less competitive with the world. And from that standpoint, it could, hamper manufacturing activities here domestically. So from that standpoint, there are, some risks on that front. It may also cause some folks to sell domestic assets and invest internationally just due to the strong dollar. Quantifiable risk due to the political environment. Well, I would just say, the Fed is apolitical, and from that standpoint, it would be inappropriate for me to comment on the political environment. Is the Fed position that real estate just has to be an unfortunate casualty of the plan to starve off inflation? I think so. So there are two mandates for the Fed. One is full employment, and second is price stability. So from that standpoint, our focus is I'm understanding a broader picture. Even though real estate, we've got roughly $2.8 trillion of commercial real estate loans on the balance sheets of the banks that we watch. Certainly, the banks are in very good shape from a capital perspective. We are testing them annually, in some cases more than annually, to make sure that the safety and soundness of the financial system is safe. But really, from a inflationary perspective, it is a bigger priority to bring inflation under control at this point. Labor force participation seems to have a number of inputs. You mentioned retirees. What about the gig economy? Is that not factored in at the moment? No, no, no. The gig economy is factored in, certainly in the participation rate information. So it is being captured there. They are capturing the jobs that are being created. Absolutely. With that, Michael, I think I am out of time and I need to turn it back to you.
Brian, thank you so much for your presentation today. It was fantastic. We appreciate you coming back on and giving us an update on inflation and what the Federal Reserve's thinking is. I've been getting a lot of messages through email, which I will forward over to you. And also, we will be sharing the presentation on the site, and I will be following up with an email where you can download a copy of the presentation. So again, we thank you for coming back and giving us an update, and look forward to having you on in the future.
Great, Michael. Thank you very much for having me. I enjoyed it and appreciate everyone's time. Thank you.
All right. Thank you, Brian.